Holy smokes, do we have a story today. So a little known hedgie was forced to liquidate tons of its assets, and this caused a massive ripple in the stock market, and it sent 8 stocks spiraling down in the last few days as large positions needed to be held to help cover margin. Now, ViacomCBS was the worst hit stock in the bunch and is currently sitting at negative 55% compared to where it was at last week. So this naturally brings up the question, is it time to buy some Viacom stock and just start printing off some of those sweet tendies with the potential returns on this upswing from 50% down to potentially now 100% up back to where it was sitting at last week? So we're going to really dig into this. First, we're going to briefly cover what happened with the hedge fund, because this is an absolutely fascinating story on every single level. And then we're going to dive into Viacom stock. I did a complete analysis of this. I know you guys love when I really dig deep in the DD. I'm going to break down their financials. And I'm going to determine if this is actually a golden opportunity, a golden shower, if you... I don't think I used that phrase right. A golden opportunity to buy into this media giant. Is this the opportunity? So I've been working on this for the last 5.5 hours. It's 10:30 p.m. I've been at work since 6 a.m. this morning. So I'm losing my mind a little bit, but I wanted to make sure I had every single fact straight before I put out this video. So sit back, grab a coffee, and let's go ahead and dive in here. So starting off with the story of the hedge fund. This hedge fund is called Archegos Capital, a very little known hedge fund. You've probably never heard of it until now, but now everyone knows of it. They were forced liquidation of more than $20 billion in stocks, basically were margin called at the highest level. Now the founder of this hedge fund, his name is Bill Wang. This is him. You know, you really messed up, Bill Wang, and margin called $20 billion. He was actually also a part of Tiger Asia, another investment firm where he previously pleaded guilty to wire fraud. Also on Friday 26, Goldman Sachs pushed Archegos Capital to sell off his positions, and this is what started the tumble. So they knew that there was some major credit risks here as stocks were kind of going down in their portfolio, but they wanted to cut the losses before it got too bad, and there still was some significant losses to the banks that were working with Wang. And funny story, Goldman Sachs expressed before this that they didn't want to work with Bill because of his allegations, actually not allegations, his charges in the past for wire fraud. They didn't trust him, and then this happens. But anyways, Wang almost pulled a GameStop completely by himself in Viacom stock. And this is because no one knew he had such large positions in Viacom stock because they didn't report the sizable position. So his firm, his hedge fund, was holding up Viacom stock because they owned so much of this. And then when they were forced liquidation, there was this sell-off. And of course, there was some additional panic because of people who were just holding Viacom and also sold on the way down. And it just simply has not recovered quite yet. Now, Credit Suisse and Nomura Bank are both also down right now in stock price and in real cash value because they lost money with this deal with Wang. So how did this even happen? How did we get here? Now, typically you have to start reporting if you own 5% or more of a stock. There's various requirements if you're owning 5% or more of a publicly traded company. This did not happen here. And how is that even possible? How do they not have to report this? Well, they're buying these shares through a derivative. They had basically indirect ownership of these shares. They didn't actually have voting rights. They didn't actually have ownership, but they were reaping the returns of actual ownership. And this was done through total return swaps, which is kind of a common instrument used by hedge funds. And it increases leverage, increases risk, increases potential returns and potential downside as well. Here's how it works. Let's say you want to do a credit return swap of $100,000 of company A. The bank agrees that they'll do that deal with you. They own $100,000 worth of that company, and they say, we will give you all the benefit of that company for the next predetermined period if you pay us a fixed rate plus the LIBOR rate, which is basically just the generally agreed upon bank-to-bank interest rate, whatever it is at the time. Let's say the total is 5%. Now, if the stock goes up 10% in the next year, or whatever your predetermined period of time is, you, the borrower, would be able to keep that 10% return on all the stock minus whatever your fees are. So in this case, minus 5%. So you made $10,000, you pay your $5,000 fee to the bank that actually owns these stocks, you get to pocket your $5,000, and there you go. But if the stock goes down, let's say it goes down 10%, and it goes down to $90,000. What happens in this case? Well, you, the borrower, have to pay the bank back the $10,000 it went down plus the fees. So now you owe $15,000 on this investment. So there's a huge downside here and a pretty big upside. So it's a very risky instrument to use, and sometimes things happen like this. This is kind of what happened with the subprime mortgage crisis, but that's a whole video in itself. But Archegos was doing those total return swaps with multiple banks and leveraged about $10 billion into about $30 billion. And then the positions that they were holding, which were largely in these media type companies, started going down. The stock started going down, and banks were like, oh, okay, we need to cut our losses here. And they forced the liquidation of about $20 billion worth of stocks, which just saw this all tumbling down. So a relatively small hedge fund relative to the market, at least, caused all these ripples, and especially in Viacom. Now let's get into whether it is a perfect time to buy into Viacom since they've been part of it. There actually hasn't been any bad news about Viacom, but their stock has gone down 55%. So this could potentially be the perfect time to jump in. Now, ViacomCBS, if you aren't aware, is a massive media conglomerate who was hit the hardest as a result of this Archegos chaos. We can see their stock price here. It's had a great year. It was running up in an awesome way. Now we know why it was running up so quickly. And then we can see just this massive drop off here. So there is potentially, we could see this recover a bit. If you aren't aware, ViacomCBS, they own tons of brands that you've heard of before. We can see BET, Paramount, CBS, ViacomCBS Streaming, CBS Studios, Nickelodeon. They own SpongeBob. Are you kidding me? They own Showtime, tons of other brands that you've definitely heard of before. They're huge. They're kind of killing it. So this is kind of an interesting stock in itself because it has both the play of a classic business that's been around for a long time with reliable brands, plus they've more recently started doing streaming services with their Paramount Plus. So it kind of has like a tech company aspect to it as well, which could give it some valuations alongside like a Netflix, things like that. So that would give the stock price a potential much larger runway to, increase in stock price. So let's dive into the fundamentals here. In my investment style, I'm willing to make a short-term swing as long as the long-term fundamentals also check out. And the reason for this is in the short term, it's anyone's guess. I mean, you can kind of make an educated guess as to whether it's going to swing up. If it goes down quickly, you can probably guess it's going to go up at least a little bit, but we don't know for sure. So by having this long-term fundamentals in the background, I know that if the short-term swing doesn't work out, I can at least wait and I'll eventually make my money back because the fundamentals all check out. So let's just go ahead and dive in. First, we're going to do an overview, and then I'm going to go into a stock screener, and then we're going to do a price target based on all of that information. So doing a real quick overview, we can see market cap currently $30 billion, revenue per employees $1.1 million, which is an awesome revenue per employee. That's one of the highest that I've seen. If we go to their financials, we can see that their 5-year trends are a little bit shaky. This is sales and revenue growth. A little bit shaky. 2020 was not a record year, and there's no definite upwards trend. The 5-quarter trend looks a little bit better, but it's still not amazing. If we go to net income, we can see kind of the same trend where there was a big jump up and then it's kind of been declining for the last couple of years. So it doesn't look amazing, but potentially for the right price, I mean, this company's not just going to disappear. For the right price, maybe it could be an awesome investment. And also make sure you grab your free stocks with Webull. Link is down in the description. All you have to do is deposit $100. You get 2 free stocks, plus you'll be giving this channel a small thanks because they're going to send me a free stock as well. So if you appreciate all the due diligence, go ahead and get a free stock or something like that. Okay, going into the stock screener. This is going to give us a much better idea as to what the true valuation is of this company. So we can see the P to E ratio currently sits at 11. This is pretty good. You can think of this as the number of years it takes to return 100% of your investment. The price to book ratio, 2.89. This is okay. We want 0.6 to 1.5 for a solid value investment. But of course, like I said earlier, this kind of has some aspects to it of a growth play. However, it's a huge business, so it's a little bit of both. It's kind of an oddball here. Debt to equity ratio, We can see here, also I have this spreadsheet, I'll have it linked down in the description if you want to use this spreadsheet for your investments as well. But 1 is usually good. However, this varies by an industry to industry. This is pretty good. 1.6, not too bad. Current ratio, we want this over 1.5. We're at 1.38, so we're close. You'll see that a lot of things with this company are either close or like they're okay as far as like the competitive advantage and the financials go right now, but the price can sometimes make up for some shortcomings in certain ratios. And then dividend yield is 2.13%, so that's pretty darn good actually. Gross margin, this is when we get into whether the company has a competitive advantage in certain ratios that help you determine whether it has that, because companies with a competitive advantage are more likely to survive long term and spit out a bunch of cash long term, and their stock price will go up as a result. In the short term, stock price might go up just because of hype, but in the long term, earnings matter, growth matters. Okay, their gross margin we can see is 39%, which isn't too bad. Selling in general to profit, this is 53%, which is fairly high, but really what we want to look at with SG&A expenses is a stable year to year. So we can see SG&A, we want it stable year to year. We can see the last 3 years have been relatively stable. There was a jump up, and I'm assuming this is when the merger with CBS happened. So that would make total sense that there was a big jump up. So that's actually looking pretty good. Going back here, R&D to profit, there was no research and development, depreciation to profit. Now this was fairly high because we want this as low as possible. You can see I have an example, Coca-Cola is 7%. We want this as low as possible. It's fairly high because they have a lot of assets. It's a very asset heavy business, which means it could potentially be not as quite of good returns to just other industries in general, but you also want to compare within this industry if you're, trying to do a comparison. Anyways, receivables to sale ratio, this is okay, 27.7%. Return on assets, 4.39%. We want this over 5%, so we can see we're right there as far as like what a great company is. It checks a lot of boxes for a good company, and then some of them for a great company. And then return on equity, we want this between 15 and 20%. We can see it's just over 15%. They just eked in there, they squeaked in there, 15.03%. Now, interest expense. We want to have as low of an interest expense as possible. Generally, a company who is super strong and has a competitive advantage has a pretty low interest expense. There's this 4.7% on their debt. It's okay. And I got this from their income statement. I actually read through a long portion of their like 400-page income statement. So go ahead and hit the like button on this and subscribe if you appreciate the amount of effort here. Net earnings ratio, we can see 9.1%. Not too bad. Earnings per share, I just wrote all over the place because you really want this consistent and going up. Like you want this predictable. Theirs is not predictable. It's like burp, 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 but what we're gonna do. Cash on hand, their cash jumped up very dramatically recently, increased to almost $3 billion, which is definitely a good thing to see. Their inventory is good, not bad. I said that's kind of a common theme here. Goodwill, they saw a big jump in goodwill in 2018, and let me just pull that up here real quick on the balance sheet. Here we are, net goodwill. We can see again a big jump in 2018, and I assume that was when the merger happened with CBS, because that would make sense. Typically, goodwill goes up when acquisitions are made, and CBS was a pretty darn big acquisition. Okay, finishing off here on the screener here real quick, we can see additional stock. Companies that are great typically don't have preferred stock, and seeing treasury stock is a good thing because that means the company is buying back, and they checked both those boxes, which is great. Investments in debt. One thing that we're looking for here is net income that can pay off total debt between 4 and 5 years. Theirs would pay it off in 9.2 years. Not amazing, not the worst that I've seen either. Okay, from here, now let's go into our price targets for Viacom and see whether this merits throwing some of our hard-earned dollars to or not. Okay, here's our price targets. So at the top, we have historical growth. Earnings per share growth over the last 5 years is 39.5%. Free cash flow growth over the last 5 years is 61%. Annualized, the earning per share growth is 6.7%. It's okay. And the free cash flow growth over the last 5 years annualized is 10%. That's basically the rate of return every single year. Now, if we continue the earning per share growth at 4%, I'm being kind of conservative here because their earnings per share are seriously so all over the place. We're going to assume 4% growth. That would result in a $4.97 per share earnings by 2025, and that would come out to total earnings of $3.06 billion in 2025. Now on to the price predictions. Okay, so we can see the historical P to E of this company over the last 20 years is 15.75. So I just wanted to use that as a metric, and I'm going to use another metric later. Based on that P to E and the earnings in 2025, the predicted earnings, we would have a market cap of $48 billion. That would give us a price target of $78.24 per share. So your return in 5 years would be 73.3%, and your annualized return would be 11.63%. Now, I think that this factors in all the various factors pretty well. The fact that they're going to do streaming, the fact that they do have earnings, they do have income, profits, and I think that that's a fair return. However, I know many of you watching are going to say, this thing was just at $100. How could it possibly only be worth $78 a year from now? We do have to remember there's a few factors in play here. One being this hedge fund that was propping up the price, and we're in the meme stock era right now. Now, this just factors in a little bit of hype and their potential earnings. This isn't to say that their stock price couldn't absolutely shoot up tomorrow, because it potentially could. But because I know people are going to complain about this, I also put together a more bullish proposal. So let's use a tech P to E of 20. Now, many people say it should be like 40 or higher, but we're going to do 20 for a tech P to E. If you want to consider them a tech company because of their streaming services and things like that, what would the price target be based on their projected earnings? So market cap of 2025 based on those projected earnings would be $61 billion and some change. That would result in a price target of $99.40 and a return in 5 years of 120% annualized at 17.08%. Pretty darn good if you're feeling very, very bullish about Viacom and their potential future earnings. So in summary, I mean, it's not too bad. I would give it a 7 out of 10 as far as potential for future outlook. It checks a lot of boxes as far as it'll likely see some kind of upswing in the future. Does it merit that upswing in the near term? It's really hard to tell if that's true or not. But based on projected earnings, I think this could be a bet where you go in as a short-term swing trade. If it doesn't pan out in the short run, you do have the backing where if you're willing to hold for 5 years, you're going to make your money back. You're going to have some kind of return, but it could mean your money is tied up for a period of time before that happens. Because I mean, heck, the stock price could go even lower before it starts climbing, and we have no idea what may happen next. And also, if you're watching this and the stock price is at $60, a lot of this still applies. You know, your rate of return is just going to be slightly lower in those cases. So that's going to do it for this analysis. I would like to thank you for watching, and I hope you have a profitable day.